And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
And good morning, welcome to the show. Of course, it is Thursday, second best day of the week as we get ready to wrap this week up. And of course, next week really gets into the heart of earnings. We've had a few big earnings out this week, but really the pace of those earnings are going to pick up over the next 2 weeks in particular as kind of all the Mag 7-ish X NVIDIA start to their reporting, kind of reporting seasons. Economically speaking, the data continues to come in okay. We didn't have a lot of data yesterday to speak of. We'll have a little bit updated today, but again, we don't have any kind of big major economic reports, except for PCE coming out. So we're going to be paying attention to that. But again, that data continues to be okay as well, and markets have continued to do okay outside of that. We talked yesterday about this whole issue with Greenland and potentially, this kind of spat with Europe and particularly Denmark over Greenland, and markets kind of sold off very sharply yesterday. And we discussed yesterday, and we'll get into this here more in just a moment, is that can change very quickly, and that's exactly what happened. President Trump gave a speech at Davos yesterday. Scott Bessent also coming out with comments yesterday about Greenland, that a deal may be closer than not to being done, some type of agreement on Greenland. And of course, no use of force, right? That was one of the biggest, like, oh my gosh, we're going to go to war over Greenland. That was never going to be an issue. But as we've talked about before, the kind of the bigger threat was these tariffs that were going to be implemented on Europe. And, as we know, President Trump used this as a stick and carrot to try to get a negotiation started. Puts the tariffs on it, gets people talking, gets to the table, can work something from there. Of course, markets overreacted yesterday a good bit, and as we discussed yesterday, not to take action on the news, right? This was the big deal yesterday. Of course, immediately after that announcement came back yesterday morning, and after his speech at Davos, markets kind of rallied yesterday and recovered some of that. So again, this is why it's always very, be careful trading off of headlines and making knee-jerk reactions in portfolios because of your political leanings or your feelings or your emotions or whatever it is. Let markets tell you what they want to do. There was, as we said yesterday, a lot of buyers in there. In fact, let's just get into that this morning. Here's what you need to know before the bell. So yesterday, as we discussed, the markets had broken below the 50-day moving average and had taken out both the 20-day moving average and that rising trend line that we had going back to the mid-November lows. So that whole rising trend was broken yesterday. Now that's still important because now that rising trend line is now resistance for the market. So again, we have this, as we noted yesterday. And if I can get my system to work here, as we noted yesterday, we have this rising trend line coming across these bottoms going back to November. Well, that's now going to be overhead resistance. In fact, yesterday we ran right into the bottom of that resistance level and then sold off just a little smidge going into the end of the day. So again, we've got that active resistance now above the markets, and we're continuing to be on a momentum sell signal at the moment. That's going to potentially limit upside in markets here, at least near term. So again, don't be surprised if we have a little bit more volatility in the markets here over the next few days. But importantly, again, we said yesterday that there are buyers out there waiting for that dip, right? There were buyers that were positioned lower in the markets yesterday, and that's why markets kind of corrected, so quickly on Tuesday. We're down 2% on Tuesday, but buyers were sitting around those lows waiting for some type of catalyst that came yesterday morning. And again, this is why, using things like relative strength indexes and MACDs, these type of things, kind of help you navigate the markets a little bit. Every time that we've had these very kind of oversold conditions on a relative strength basis, you'll note that those actually correspond with short-term bottoms in the markets. And again, this is when we get these kind of sell-offs that, you get these buyers step in. So again, this is why it's important to, not overreact. As we said yesterday, hey, give it a day or so and kind of see if there's going to be any follow through to 1 day's worth of selling. And of course, yesterday we had some buying coming in. We got back above the 50-day moving average. So again, this is why be careful with your stops. As we said yesterday, a lot of focus on those 50-day moving averages, like, oh, if I break that, I'm out. But the problem is that also all the algorithms are looking at all the stops that are sitting there at the 50-day moving average, and as soon as they take them out, they start buying them. And so again, give this a little bit of room. When you break these moving averages, give your portfolio a day or two, and let the market see what it wants to do. And again, we immediately kind of recovered. That's still the 50-day still active support right now for the markets. This morning, futures are pointing a bit higher. So again, we're going to get some more follow through today. The next question here for the markets is really twofold. One, we're still oversold enough here for a further rally. We need to convert this MACD sell signal back to a buy signal if this market's going to continue to rally. So again, near term, I still expect there's going to be some resistance overhead. But if we can get back above this rising trend line, that's going to put the previous kind of all-time highs, kind of into focus. So again, we're still going to wrestle with that resistance at 7,000. But again, if the markets can break above that, now we've got a lot of catalysts here over the next really kind of month or so. We've got earnings, really the heart of earnings coming up over the next 2 weeks, and then that opens up stock buybacks and insider buying after that, because insiders can start buying their stock back again. So if we can get above 7,000, that'll certainly put us in target for 7,100. But again, we still have this resistance level right now we've got to deal with. So again, don't become overly bullish here. But again, this is why we were saying yesterday, don't take 1 day's action and start making major portfolio moves because of that. Let markets kind of work themselves out, figure out where the algorithms are buying, figure out where the buyers are. And we saw that yesterday. They're hovering right there around the 50-day moving average. Nice little volume pickup. Again, relative strength picked up. So again, markets are okay, trading okay right now. Nothing to be overly concerned about. But again, it's going to be a lot of news headline generated volatility here over the next couple of weeks in particular because of earnings. So again, you have to navigate this a little bit cautiously. All right, that's what you need to know before the bell this morning. We'll come back, pick up with Michael Lebowitz. Don't go away.
Catch the best of The Real Investment Show anytime, anywhere from iTunes. Download podcasts of The Real Investment Show from iTunes.com.
Oh, Red, I declare, I plumb missed that candy coffee. Whatever am I gonna do?
Don't you worry, little darling. We'll watch it again on our YouTube channel.
Why, Red, I never.
The Real Investment Show YouTube channel has all of our past presentations, from Candid Coffee and Lunch and Learn to special topic discussions, and all of our live show recordings preserved for you. Subscribe now to the Real Investment Show YouTube channel, or look for the link on our website at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. Michael Lebowitz joining me as well, talking a little bit about a few things that are coming up here in particular, but also just kind of discussing a little bit of what's been happening here over the last couple of days in particular. One of the big topics that really got investors' attention really over the last 2 days was this whole conversation about this Greenland acquisition, and of course this the news headline that this Denmark pension fund, can't pronounce the name of it, the Dutch, I mean, come on. Yeah, exactly, Danish, sorry, I said Dutch, Danish. But yeah, so there was this, they're going to sell all their treasuries in response to this news of Greenland. Of course, Denmark is kind of the de facto owner of Greenland at the moment, so they've got a little bit of skin in the game. But this pension fund says, well, if you do that, we're just going to sell all of our treasuries. And of course, this made a lot of headlines like, oh my gosh, see, this is now the beginning of the end for the U.S. Treasury. Everybody's going to get out of U.S. Treasuries. First of all, you've got to keep all this stuff in context. And for instance, if Denmark sold all of their treasuries today, it would not even move the market. It is such a small amount. They have about $100 million worth of treasuries on their books. So it's a very, very inconsequential amount. And again, the markets would absorb it very quickly and move on. In fact, Mike Lebowitz pointed out to me yesterday that our firm, RA Advisors, actually holds more treasuries than Denmark does, this Denmark pension fund. So, so again, got to take these, makes great headlines, makes for great news, makes for great narratives, but it doesn't mean a whole lot at the end of the day because it's a function of how markets work. The second thing is that, well, this means that Europe's going to start all selling, their bonds. Well, the problem is that's not really possible. And by the way, we covered this a little bit in detail in this morning's daily market commentary on the website. But most of the treasuries in Europe are owned by pension funds, hedge funds, private investors. It's not really controlled for the most part by the central banks. So trying to get a coordinated effort to sell treasuries, it would be extremely difficult. But more importantly, again, U.S. treasuries are a function of reserve currency. And so it's almost a nuclear option for Europe to do that. Anyway, thought Mike and I could discuss this a little bit. We'll get into also talking about Kevin Warsh this morning. Kevin Hassett is now out of the running. President Trump has said he wants to keep Kevin Hassett where he is. So this puts Kevin Warsh into the leader seat over Chris Waller. But again, we'll get into all this morning. Mike, welcome to the show. How are you?
Good. I'm doing really well.
Good.
Can I?
Sure.
I think that story is interesting. I think you pronounce it Academier.
Yeah, you go for it.
But I could be way wrong, and Brent may have to bleep me out on that one. But what I thought was interesting about that story, and it's the way the market gravitates to a narrative. $100 million is nothing, Lance. Way back in the day, I used to trade bonds institutionally, and we would go to market in the billions. If we would go to market saying we want to buy or sell $100 million, we'd call up a JP Morgan or a Goldman Sachs, say we got $100 million for sale. Hold on one sec. I was just going to go grab a snack. I'll get right back with you, and I'll call it into the trader. You call $1 billion in there, say, yeah, you call 5 traders, and then you're getting bids. $100 million was absolutely, it's crazy, but it's peanuts in that market. And like you said, we have multiples of $100 million, and we're just, we're a relatively small wealth manager. So, but the market elevated that story as, part of the fear that was being spread a day or two ago about all this mayhem that was going to happen, right? It seems like commonplace for the market to just drag out these narratives and highlight anything that fits the narrative and elevate it to a status that it doesn't belong. If the European Central Bank said, hey, we're going to get rid of half our treasuries, that's a very different story. Or if a country like Germany or France made a comment like that and followed through, very different story. But like you said, they can't. Right. That's their checking account for global trade.
Exactly.
Good luck. Good luck with your euros or your gold.
Yeah, it's even the comment. It's like one of the comments in chat was, it's not the amount, Lance. It's the symbolic action. A longtime ally flipping off the U.S. Yeah, maybe. But again, it's a pension fund. It's not an ally, right? It's not the country itself. It's not Europe flipping off the U.S., right? This is a pension fund that says, okay, we're going to sell our treasuries because we don't like what Trump did. If that happens every day in the markets. I mean, right. Whether it's Biden or whether it was Obama or whether it was Bush or whether it was, President Trump. I mean, presidents do things, countries make, symbolic actions all the time, but it doesn't change the outcome of how the markets work. And this is the most important thing to understand. All these narratives are fine, but most of these narratives are not based on foundational facts about the way markets actually work. So the narratives are fine. There's nothing wrong with it, but the narratives are the rationalization for why things are doing what they're doing. Why are interest rates going up or why are interest rates going down? Why is gold going up or why is gold going down? Why are stocks going up or why are stocks going down? When something is going on, right, that either supports our view or negates our view, we come up with rationalizations, these narratives for why this is occurring. But at the end of the day, as we talked about before, it's always a function of just what's happening within the markets, and you need buying and selling demand to move that. And just like we saw yesterday, bonds rallied very sharply, coming back from, kind of this knee-jerk reaction to the news. Again, these news headlines are fine, but again, as we were talking about yesterday, don't trade your portfolio on that, because that's where you get yourself into trouble.
Lance, here's one for you. Over the last 2 weeks, there's been a 10-year, a 30-year, and then a 20-year auction.
Right.
All three auctions went really strong. 2 of the auctions saw the second largest foreign buying ever. Foreign buying,
right.
Not U.S. buying, not domestic, not the Fed, not U.S. pension funds or endowment funds. Foreign buying.
Well, this is a great point.
Did you see anything about that?
Right. That's exactly the point, right? You saw nothing of that in the headlines. However, if you take a look at a history of auctions, we have strong auctions and weak auctions all the time, right? And we're talking about minuscule changes in what the yield is. It's kind of the expected yield versus what the yield goes off as. So you have these, great auctions and failed auctions, but the only ones you hear about in the media are when the auctions fail. An auction failed. It's, there's no foreign buyers showing up. The dealers had to take down the majority of that. Those happen all the time, right? For decades, those have happened. It's the way the bond market works. But yeah, it's interesting, Mike, when you have these really, really strong auctions, nobody talks about them. The only ones you hear about are the ones that fearmongers can use, saying, okay, the auction failed. It means that nobody's buying treasuries anymore. And that's not even what that means. It just means that the auction didn't hold at the yield that they thought they were going to hold at, and it's a very small change. It's 4.01 versus a 4.02. Oh my gosh, that's a failed auction. But these are the narratives that people hang on to kind of stoke fear into the markets.
And Lance, if we were in a market where bond prices were rallying, bond yields were falling, and that was the narrative. Narrative is we're going much lower in yield. Those auctions would have been the headline on the Wall Street Journal. Sure. They would have been on the front page of the Journal. Great bond auction. The foreign demand off the charts. They can't buy enough of these things. But that's not the prevailing narrative, so no one hears about it.
Yeah, exactly. Somebody put in comments, glad the summit was last weekend, getting cold here. Yes, we are going to be freezing our bojangles off here over the weekend. But But Mike gets cold all the time. So for us, freezing weather, we shut the whole city down. In fact, we're not even going to be here on Monday. We're just going to stay home. The ice is going to freeze us in. What's the temperature there right now, Mike?
I'm sorry, what?
What's your temperature now?
It's not bad. It's in the 30s, but we're supposed to get 1 to 2 feet of snow coming this weekend.
Yep. See, yeah, and we're over here going, we're going to get some ice and maybe some sleet over here this weekend. So hunker down.
Change my
I'd
name
rather
to
have snow
Nano.
than ice. Ice is the worst.
Yeah, ice is the worst. Absolutely. But yeah, so by the way, just your friendly neighborhood warning, be sure and wrap your pipes this weekend, because it's supposed to come. It comes in Friday night, right?
The timing is still up for grabs between Friday and Saturday night.
Yeah. There you go.
And lingering into Monday and Tuesday.
Yes. The lingering.
And then, if you look at the price of natural gas, that's your weather. That's your meteorologist. Is the price of natural gas? It's up to like $5.50 now. It's up another 20% this morning.
Yep.
It's telling you that this cold is sticking around, because the natural gas traders are kind of looking out 2 weeks, 2 to 3 weeks. So they're telling you that this Arctic vortex, whatever they're calling this one, ain't going away anytime soon.
Right. I mean, Brent, here's a graph of natural gas just to show you what Mike's talking about. This has been something, it was interesting because Mike and I were playing natural gas stocks as exposure for kind of behind the meter power gen for AI data centers. And instead we got cold weather, which was interesting because, I just recently took the family over to Beaver Creek in Colorado, and there was no snow, like literally no snow. They were having to make snow. So there were only 6 slopes open. They had to blow snow up onto the mountain so people could ski. But it's been a really, really temperate kind of winter so far. Really, November, December, and even the first half of January here in Houston has been very, very mild. I mean, we've been in the 70s, the high 70s, even the low 80s a little sometimes. It's been a very, very mild winter, but I kept telling my wife was like, "This is great. We've had no cold weather." I go, "Honey, just hold on, because
She jinxed it.
Yeah, because it's coming, and it's just coming a little bit late this year." But yeah, we're about to get it. But yeah, that spike in natural gas is quite interesting.
And unlike other bubbles, that is due to the weather. That is due to the expected uses of natural gas, and that will be back down in a few weeks. It's
Right.
almost predictable. It's not permanent. There are going to be no narratives that drive it up and down. It's almost a pure market. It's really supply, demand, and how does the weather affect supply, demand.
Exactly. Let's switch gears here and talk a little bit about Kevin Warsh and what's going on with Chris Waller. I thought this was interesting this morning. I put this out on Twitter. This was a chart that UBS put out. And now, now this compares Kevin Warsh to Chris Waller, because Kevin Hassett's out of the running. So it was really just those three guys. And Chris Waller has really actually never showed up. And Polymarket, you have your article today talking about this a bit. But Chris Waller was never actually in contention. His odds were always extremely low. It was always either Hassett or Warsh. But I thought this was interesting. This is the chart. This compares Kevin Warsh to Chris Waller. So this looks at Chris Warsh when he was the Fed governor in from 2006 to 2011, with that of Chris Waller from 2020. And basically what it shows is that Warsh's stance was considerably more hawkish than the median both before and after the great financial crisis period. In contrast, Waller's stance was mildly more hawkish in 2022 when we had that inflation episode, but has been consistently more dovish, has had a consistently more dovish stance than Chris Waller, which I thought was interesting, because everybody was kind of saying, "Oh, well, Kevin Hassett, he's the hawk of the group." Kevin Warsh is the hawk of the group, but it actually turns out that Warsh is a bit more dovish.
Yeah, I think the concern, so this is hard, right? Bond yields have been slipping up they came down yesterday, but prior to that, they were kind of rising the last few days. Some of that was Greenland tariffs, and it's hard to separate things out. But it was, Friday or over the weekend, where President Trump said that Hassett is out, and the market just assumed that Warsh was now in the lead. So the reason the market may not love Warsh is, I think he is deemed to be more hawkish. He certainly speaks more hawkish. He was at the Fed in 2008. He was doing QE. He was saving banks. But he has since found a little religion. He's anti-QE. He thinks it should only be used in crisis situations. So I think the market, in addition to being hawkish, I think it's his lack of willingness to use QE on a sort of daily basis, which is what QE has become. It's become the way to feed markets with liquidity. Now, that sounds great. That's music to our ears. The problem is the Fed has taken over the role of liquidity provider from the banks. So if the Fed is not doing QE, how are banks going to get liquidity? What does that mean if banks can't really functionally operate? So I think Warsh is a potential problem for the markets, both stock and bond markets, because QE becomes less of an option potentially. But again, I know he leads the Fed, or would lead the Fed, but he's just one of 11 votes at the Fed. So it's not the end all be all. The one I think to keep an eye out on is not Waller, but it's Rick Rieder. He's the CIO of BlackRock. And I believe he interviewed with Trump late last week. I think that's the one that could sneak in there. He's very much a markets guy, right? He's the CIO of BlackRock.
Right.
So he's kind of he's worried about the banks, first of all, because that's his job. But I think financial stability, AKA let the stock market zoom ahead, let bond yields come down, is kind of his focus.
Yeah, he's by the way, Rick Rieder is a super bull. Like he's
Right.
always bullish.
Right. So, I'm starting to think that he's maybe the guy that, or, thinking the way Trump thinks, that he wants interest rates much lower. He probably wants QE to pump the markets up. I think he's the guy. I think that's the one that may come through. I mean, Warsh is still the front runner in the betting markets, and we have to assume right now that that's the way it's going to go. But Rieder is the guy, and he's also been very not very, but outspoken about fiscal deficits, and understands the need for basically to fund them, which means that he would keep rates artificially a little bit lower so that funding treasuries is easier, supporting markets. That's a very market-friendly pick. So what we'll see is, I think Warsh is a little bearish for stocks and bonds.
Right.
I think Rieder's bullish for stocks and bonds. So it'll be interesting to see how well poly markets correlates with what's going on in those markets. Now, the hard part is there's news coming out every day but like we just talked about, that's causing chaos and then causing the market to reverse the chaos. So it's hard to know exactly how these things are impacting it, but I think that's the one that's not being talked about that we really need to follow.
It really hasn't been talking. And my only problem with that selection, if they actually did pick Rick, is that would just cement the marriage between the Federal Reserve and Blackrock. We know, but back during 2020, when we were having the pandemic, and the Federal Reserve started buying junk bond ETFs, they basically put BlackRock in charge of that action for them. So, there's already a very harmonious relationship between the world's largest asset manager and the Federal Reserve. And, you pull Rick Rieder in, or Rick Rieder into the Federal Reserve as chairman for that. That just pretty much says that now the entire monetary system's run by BlackRock. So, I think there's going to be that concern somewhere along the way.
Right. But what's interesting is Trump's had these little spats with the banks.
Yeah.
Like right now, him and Diamond are not getting along. So maybe that argues that it is Warsh, because Warsh is kind of anti-QE, whereas Rieder is a banker. But, the banks own the Federal Reserve. So how much kind of pull do they have with the president on that? And, as always, what happens behind closed doors is very different than what we see and hear. So just keep an eye on Rieder. But I think Warsh right now is still the front runner.
So, it's very interesting. Because as we start to look, the markets are so focused on what the Fed does. And again, this is kind of the ongoing risk that we've talked about from time to time, is that the markets aren't being driven by fundamentals. They're not being driven by valuations. They're not being driven by things that you would normally trade off of. It's simply a function now of what's going to happen with the Fed next. Are interest rates going to, are the Fed's going to cut interest rates or not? And, I think that's still one of the big risks as we start to look out to this year. As we discussed at the summit last weekend, this reflation narrative, and you see this across asset classes. Industrials have been surging, basic materials have been surging, commodities have been doing well. And this is all kind of this narrative of this reflation trade where we're going to get above trend economic growth, but no inflation this year. But that's going to be very difficult to kind of manufacture, because if the action that we're seeing in equities right now is representative of this actual economic reflation story, and that is what's going to come to fruition over the course of this year, just stronger growth by in and of itself is going to start to pull inflation higher, and that's going to put the Fed in a tough bind of continuing to cut rates. So, one of the bigger risks this year may be a Fed that pauses or slows down rate cuts, or even, heaven forbid, have to hike rates because you're getting you're getting a reversal in inflation, and because of this stronger economic growth, you start seeing wages pick up, you start seeing inflation pick up, and all of a sudden this whole narrative of low rates supporting the markets can become a lot more challenging.
Well, to your point, we've kind of had this scale with employment, weaker, stagnating employment on one side and higher inflation on the other side. And, some of the Fed voting members are saying we need to address labor markets. Some of them are saying we need to make sure inflation doesn't slip any higher. We want it to come down. If we do get this really good economy, call it 3 to 5% growth, there's no way that the labor market continues to stagnate. It's got to improve. So if it improves, that one worry at the Fed is gone. Now it's all about inflation. And on the margin, like you said, if the economy is doing better, we would expect inflation to rise. So that argues for a very hawkish. It's hard to be dovish in that environment when the labor market is, if we're back to producing 150 to 250,000 jobs a month, but let's just say inflation is stuck at 3%, maybe even starting to drift a little higher. It's going to be hard for any member. I don't care, even Stephen Moran to really say we need to cut rates here. So, I think that's a dynamic the market's not thinking about. The Fed that has no choice but to A, not cut, but B, consider raising rates.
Well, and again, that's going to impact things like valuations. The discount rate. Again, the whole hope is the Fed's going to cut interest rates, so we're running up stocks based on the discounted rate of future cash flows, so we can justify that because of lower rates. But that can change pretty quickly. And again, when we start talking about market risk, and we're not. And by the way, we're not. Mike and I are not saying this is going to happen, right? It's just it's our job as risk managers is to look out and say everybody right now, the large propensity of asset managers are on this side of this reflation narrative, above trend economic growth with no inflation. That's the expectation for 2026, which that's going to lead to very accelerated earnings growth this year at a rate of growth that is the highest deviation from the long-term exponential growth trend of earnings ever on record, going back to 1900. So when everybody is bullish, Bob Farrell was a technician for many, many years and had a list of 10 rules that are widely quoted all the time. But number 9 is when all experts agree, something else tends to happen. And that's kind of the problem with the markets right now, Mike, is that everybody is expecting this reflation narrative of economic growth with no inflation. The Fed's going to keep cutting rates. And because of that, we're willing to very much overpay for asset prices right now, which seems to leave a lot of risk of disappointment during the course of this year.
Here's the other kind of interesting thing I was just thinking about. That narrative that you just laid out is very bullish for the mega cap top 10 stocks. They're performing poorly.
Right.
Market doesn't care about those. It's betting that the small and mid cap stocks benefit the most from that trade. Right?
Which would make some sense, right? If you do have an economic reflation, small and mid caps should do well. The problem with that is that when you take a look at the breakdown of performance in the small cap index, it is the non-profitable companies that are outperforming right now versus the profitable companies. So investors are chasing the most speculative assets within the markets currently, and that's more of just a speculation trade, not really a bet on economic prosperity.
Right. And you also look at some of the valuations, NVIDIA, Microsoft, they are cheap. I mean, I know it sounds crazy because they have a PE that's high, but when you incorporate any kind of moderate growth rate, and I'm not talking pie in the sky growth rate, NVIDIA has a PEG ratio of 0.50. So even if the market is wrong, twice as wrong on how their earnings grow over the next 5 years, it has a very cheap PEG ratio, which would be about 1. So, I think the risk with this reflation trade is that, let's just say it does happen and everyone goes into small and mid caps and maybe their earnings do get a boost, but it's still hard to see how that money doesn't flow to those large cap stocks that have already shown they can produce great earnings in a meh economy. What are they going to do in a better economy?
Right.
So, you have to think about the narrative, but also think about which stocks are being led by that narrative, and does that even make sense, even if you believe the narrative itself? So there's multiple kind of stories or floors to this narrative,
right,
that are worth thinking about.
Yeah, and I mean this is a chart of what I was just talking about a second ago. So again, I had this I talked about speculation in the markets, and I got this email and it's like, I don't see any speculation in the markets. I'm like, okay, well, here's a chart for you. So this is the Russell 2000 companies with negative EPS versus those with positive EPS. The green line is negative EPS. So investors are buying the companies that are non-profitable. But here's the more interesting one, Mike. This is and this is something that I think is a much bigger risk to the overall markets longer term. And we just had this discussion with Mike Green last Monday. But this is the number of active ETF launches by year. And Mike can't see this chart, but what you're looking at here, Mike, is a chart where you see the number of ETF launches, which are just surging over the last 4 years in particular. They're just absolutely surging. And in 2025, there was over 1,000 ETF launches just in 2025. And a big chunk of those were for more speculative, short-term trading, single stock, leveraged ETFs, right? So the more speculative nature of ETFs. So there's a massive surge in ETF launches last year. Of course, not surprising, by the way. I mean, this in and of itself is not surprising, because when you have a lot of demand of market participants to get access to a product, right? We start coming out with all kinds of products. Remember this, we did this in 2021. We couldn't get IPOs to market fast enough, so we did SPACs. Well, now it's very easy to launch an ETF. It doesn't take a whole lot. You need about 10 million in assets in terms of AUM to really kind of just make it work. But you can get an ETF launched very easily. There's whole companies set up right now that'll just, you call them up and say, hey, I'd like to launch an ETF, and they'll put it all together for you, file it, and you'll have an ETF. You just have to get the assets to maintain it. And this is going to be the key point on two levels. The problem with this kind of surge in ETFs is that they're all fighting over the same dollar. So the more ETFs you have out there, the higher the probability that a lot of these ETFs are going to fail. Because again, if you don't, to make an ETF profitable, because you've got to pay for filing fees and regulatory fees, and you got to have expenses that you run the ETF with, those type of things. So you need, at least $50 million just to kind of start making it really kind of work. And you need $100 million under AUM to really kind of start to become profitable. So a lot of these ETFs are not going to make. So people are going to put their money in these ETFs, are going to wake up one morning and the ETF's going to close. And particularly these leveraged ones. We just saw this recently with a couple of ETFs that basically went to zero overnight. Their actual NAV was 0.0000 4 decimals of value because the leverage went backwards and reverse. So a lot of these leveraged ETFs, in certain areas, think about things like the 2X MicroStrategy. If Bitcoin doesn't start to recover at some point, that ETF, because of the optionality that is inside that ETF, you are running a bigger and bigger risk that 2X ETF will eventually work its way towards zero just because of the optionality. And that's just assuming that MicroStrategy and quote unquote Bitcoin, because it's a trade on Bitcoin, doesn't recover. So, and again, it doesn't mean that the price has to keep going down. If MicroStrategy just starts to stagnate, those option rolls will continue to eat into the principal. And if it doesn't start to recover, you start getting asset flows out. People say, well, this isn't working, I'm going to take my money out. And that problem really starts to compound, and you kind of wake up one morning and that ETF gets closed down. So there's this kind of speculative feed into the markets is we're bringing a lot of product to the market to meet demand, but that doesn't mean we're bringing good product to the market. And that's so the real message here is really kind of twofold. One, be careful what you invest your money in, but also B, this is also part of what's fueling the markets. As people buy these ETFs, this passive flow then feeds the rest of the market as well. So we have this whole loop, and the question is, at some point, does that feedback loop of these ETFs start to work against investors rather than for them? Anyway, go ahead, Mike.
Right. No, I was going to say, I believe it was Daniel spoke about this at our conference on Saturday, right? The gamification of the market. And he talked about the 0 day to expiry options. And what are they now? 60, 70% of total volume of options outstanding. Like you said, the amount of of ETFs out there. And what that does is it spreads out the liquidity. So you have your big ones, your SPYs, your GLDs, your SLVs, those are fine. But all these little ones are not going to have liquidity. So when the S hits the fan, you're going to see just the bottom fall out on some of these. And that's going to scare traders. I'm not going to use the word investors because a lot of this stuff is just traders. And it's, a lot of the same people that are heavily involved in sports betting. And now with this new kind of what's like Kalshi and it's like events betting or whatever.
Right.
Polymarket. You're betting on events, and it's a little different than sports betting, but it's the same concept. That it's just a gamification, and markets have completely fallen into that, where it's not, I'm going to invest and try to earn 5 or 6% a year because that meets my goals. It's like, I'm going to try to double my money like you would with a sports bet. And that's in an up market, in a bullish market, that just propels the trends. It's support. But when this thing does reverse, and the reversal is lasting, so not a few weeks, but it starts to become obvious over months that we're in a downward trend that could last for a year, for more than a year. I think that all starts to unwind because people get bored. I'm done with stocks. I'm better off in sports, or better off. We got an election coming up in November. I'm going to put my money on this person or that person. The hell with stocks. They just go down. Why am I playing with that anymore?
Right.
So that's the risk, is that this power driving the markets up can be taken out pretty quickly.
Right. Well, and again, this is kind of the things that we've talked about before, is that we're all speculating in the markets. And you kind of mentioned it and said, as investors, we should be investing to achieve some certain rate of return every year just to meet our financial goals. So, in order for me to get to my retirement goal of, whatever it is, I need 4% a year or 5% a year. But I'm not satisfied with that. When markets are going up 20, I need 20. And so people start chasing performance. And this is fine. There's nothing wrong with it. But, they subscribe to investment services. They'll subscribe to a newsletter. Some newsletter guy says, oh, yeah, I've been outperforming the markets for 10 years using this strategy, whatever it is. And so they move into that direction, and they take on this kind of persona of, I can get higher rates of return. I'm smarter than the markets because I have these tools at my disposal. So now I can outperform the markets. That's all fine until it doesn't work, because the issue, to your point, is that once you start to move beyond your required rate of return, 5 or 6 or 7%, whatever it is, and again, some reasonable rate of historical returns, once you move beyond that, there's not a problem with it necessarily, but you have to take on more. It's not a incremental increase in risk. It's an exponential increase in the amount of risk you take that potentially exposes you to a catastrophic outcome. And we've seen this numerous times, that we forget about these periods, right? We talk about them in kind of these nuanced manners. It's like, oh yeah, back in 2008, markets were down 50%. You look at a chart, you can barely see the 2008 financial crisis now on a log chart. It just looks like a little blip. It's like, oh yeah, no big deal. That was a 50% decline. .com crisis was the same way. It was a 50% decline. Was it the end of investors? No, but there were investors that were completely wiped out during those two periods because they had leverage and margin and excess speculation risk and those type of things. They never recovered, ever. There wasn't a recovery coming back and getting back to even for a lot of these individuals. They were completely wiped out of the markets because they had taken on so much risk with their portfolios. So this is why Mike and I talk so much about risk management over time and just trying to, navigate these markets for what they are. Our goal is to make money, and we want to make good returns every year. That's our goal. But my goal and our goal is not to try to beat the market every year. It's try to create returns on a risk-adjusted basis that are survivable over time, because eventually this market will work in reverse. It's a function of time and a function of how liquidity in markets work that eventually cause these reversions to the mean. Doesn't mean this year, doesn't mean next year, doesn't mean 2 years from now, doesn't mean 5 years from now. We have no idea when another reversion will occur. But what we do know from history is that these reversions do occur, and they tend to occur much more frequently from extremely elevated valuations and speculative attitudes like we have in the markets now.
And we've also shown that just limiting your losses in those big down years is huge. That's more important than riding and trying to get everything out of the market going up. I also think it's important, Lance, that over the long run, we should probably expect, what would you say, 7-8% from the stock market?
Yeah.
So when we have these years where we're up 15, 20, 25% year after year, has something really changed? The economic growth rate hasn't really changed. Corporate margins are a little better. There's some stories on the fringes, but if you're going to keep having these 15, 20% years, and we know over 100 years, the average will be 7, 8%, you need to expect a couple years where we're down 30%, 40%, 50%. So again, how well you can just limit those losses is more important than trying to capture every penny of that 15% rise or 20% rise.
Yeah. It was an interesting comment here that says, and yet the market multiples went higher over time, small number who actually blew up. That's really not the case. The amount of financial devastation and during the dot-com bust and during the financial crisis was very broad. There was a very large devastation that occurred from those two events in particular. Yes, markets went higher over time, and there were people that survived it. I survived it. Mike survived it. We did well in those markets, but a lot of people didn't because of speculation and risk and not understanding how markets work. And so again, our whole point is to just be careful and to understand that we're in a very late stage cycle in this current secular period that we're in. And secular periods always have two halves. They have the first half and the second half. We're in the first half of this secular period. There will be a second period that will also be secular in nature. And these cycle all through history, right? These secular periods last somewhere between 15 and 20 years. We're now 16 years into this current period. So we're at which means we got another 4 years potentially. 2030, potentially, yeah. But you're at the later stage of that. And so, the problem is when the next secular period starts, most people won't realize it until way after the fact when the damage is done. But this is why when you take a look at the wealth of the markets, right? The vast majority of the wealth is owned by 10% of the population, because a lot of people wind up devastating themselves over time because they don't invest in their 401ks, they don't dollar cost average, they don't do all the things that they're supposed to do financially to help build wealth. They spend in excess of their means, they take on too much debt, and those type of things lead to these economic disparities that we see within the economy. So, look, if you're listening to a financial talk show at 6:47 in the morning, you're probably doing okay for yourself. You've probably got some skin in the game. You probably understand what you're doing. You're going to be fine. Just understand that that's not the majority of people, right? You're in the minority versus the majority. It's not the other way around. Anyway, all right, Mike, thanks a lot. That wraps up the show for the day. We will be back tomorrow for Financial Fitness Friday. Monday, we've got an interview for you. A continuing edition of our interview series here. So we'll have that for you Monday morning, just because we're just a little worried about the freezes here as well. So we just I don't want Brent. He drives a Miata. You put a Miata on ice, it becomes a skate. That's all it is. So I worry about him. I want to be careful. Anyway, we'll have an interview for you on Monday. Then we'll be back live here on Tuesday as well. Newsletter out this weekend. The full edition returns. We'll be talking about risk and that portfolio, investor risk. So again, in that newsletter this weekend. So make sure you subscribe to the website, realinvestmentadvice.com. Be sure to like and subscribe to the channel. Helps us a whole lot. See you back here tomorrow.